Hello everybody, Jackson here with the Wealth Squad. Today we'll be talking about the PEG ratio and its use and its importance in calculating or valuating a stock or investment. So PEG ratio is essentially made of another ratio, which is the PE ratio. So here's the PEG. To calculate the PEG is the PE, which is a 35 number, over the EPS next 5 years, which is the long-term annual growth estimate 5 years into the future. So that's going to be on average basis. It's not going to grow 18% 5 years. It's going to grow 18% for the next 5 years. So you're going to go 35, and that's going to be over the 18% here, and you get that 1.98 PEG ratio. But how you calculate the PE ratio is made of simply the price 190 over the earnings, the EPS number, which is $5.30. So there's a couple different ways you can impact this ratio. There's 3 different ways, right? Either, like let's say the PEG is 2 right now. Visa goes down $10. The stock goes $10 down. The PE ratio will now be less because it's price over earnings. If it's 190 instead of 180, you're going to get a lesser number. So let's think, 30, right? Or we could do 33 instead of 36 essentially. So we could do 33 over that'd be this 18% here, and we get a 1.83 or 1.85 PEG ratio. Just because one factor moved means it all does, right? The end result does. Now, another thing would be the EPS. Let's say the EPS exceed next year, EPS next year is $8. Well, that's a very strong progression from $5.30. So what we could do is do an $8 estimate instead of, we could do the calculation 190. Here, I'll pull up my calculator here. We can do 190 over $8.38. That gives us a PE ratio of 22, which is essentially this number. That's exactly what that number is, because the forward PE ratio is looking into the future year. You can see right there, next fiscal year, and calculating the PE ratio based on that. So next year's PEG ratio, if this number stays the same, if this number stays the same, and this number goes to $8 instead of 5, that will be over, we can calculate right now, over 18, 1.3, 1.259, so 1.26. And that's a lot closer to 1, which is the target for the PEG ratio, than 1.98. So a lot of numbers I threw at you there. Hopefully that makes sense. What you essentially need to know is the PEG ratio measures the price, measures the earnings, and measures the growth. That's what the acronym is for, price, earnings, growth. So you can see PE is already calculated. It's already given to you at a number of 35.86. All you have to calculate is the growth, put that 35.86 over this number right here, the estimate for the next 5 years of 18%, and that's every year for the next 5 years, not just in 5 years it'll grow 18%, it'll grow 18% for the next 5 years, every single year on average. So what the PEG ratio represents is basically a 1 is a fair valuation. That means the earnings, the price, the growth is all fairly valued to where it makes sense to buy. Now below that is an even better deal, right? If you get it at 0.7 or 0.5, that's a steal. But Visa's at a 2 right now. Is Visa still a bad investment because it's at a 2 instead of a 1? Well, in order for it to be at a 2, we'd have to get it to cut in half, right? That's a large risk, because that's not going to happen for Visa. You can't wish $200 billion to go away in a couple of days, right? We can't let that happen. Or maybe a year, right? Visa going down 50% in a year is kind of unachievable. What we can do is increase our growth, right? Increase our growth estimates, or increase our current earnings. And what's going to happen is next year we can calculate the PEG for next year, and we already did that. That's this number, since it's a forward-looking PE ratio, over the current growth estimate for the next 5 years, and you get 1.26. And that's a lot closer to 1, and I think that's a much better valuation than a 2 PEG ratio. 1.25 instead of 2. I would feel great investing in a stock like that. So there's more to it than just this one number. You have to look at the forward earnings growth. But what we can look at here is stocks with a 1, under 1. But for this, we could do under 2, just because we need some background data, right? Let's check out Microsoft. And I'll pull up my calculator here. We could see exactly how they found that number. So you can see a 25 over a 16, and that'll give you a 1.6. So what we can do is do 23 over 16, and I'll give us a better number, not by much, right? Because you're going from 959 to 1074. That's not a large jump. So let's go do a different stock here. We could do Home Depot. Home Depot's very cheap right now. Also not the biggest change, but we can see here it might be bringing us down below 1. Okay, so P ratio right now is 17. Forward looking is 15.5. And the PEG is 1.18. So almost to that 1. And it's Peter Lynch's valuation method anyways. He came up with this. So we're going to do a 15.48 over the next 5 years at 14.6. So we're not going to get that 1 exactly yet, but we get a 1.06. And I'd say that's pretty dang close to 1, where you don't have to increase your earnings by much or the stock to go down very much in order to achieve that. We can check out something else just to see. We can check on Nike here. Nike is a bit of a premium company where we're not going to get the same deal as with 3M or Visa, or not even Home Depot. So we can see right here at 4 PE of 23.6 over next 5 years at 15.3. So we're still getting a 1.7 or so, or 1.5, sorry, 1.54 instead of a 1.85, but we just have to wait a year. Now in that time frame, Nike stock could go up, so in reality it could still be the exact same of 1.85. But we know we are getting a forward-looking deal on a stock that has been trading 40% below the 52-week high. So you have to look more into the PEG ratio rather than just getting the end result number. You have to look into the next year. Are earnings supposed to grow? If so, what will my PEG ratio be next year on the same current stock price? And that is basically a forward-looking metric in order to get you the best deal on an investment of your choosing. So I hope that makes sense. Thank you for watching. I hope you incorporate this into your research, and until next time.